What is risk? Risk refers to the uncertainty or likelihood that an investment's actual returns will differ from its expected returns. This includes the possibility of losing part or all of the invested capital. In investment terms, risk is typically seen as the chance that the outcome will not be what was anticipated, particularly that an investor will not receive their expected profits or may incur a loss. Types of risks. Market risk. The risk that the value of an investment will decrease due to movements in market prices. This type of risk can result from various factors, such as economic downturns, political instability, or shifts in supply and demand. Interest rate risk. The risk that changes in interest rates will negatively affect the value of an investment, particularly fixed income securities like bonds. For example, when interest rates rise, bond prices tend to fall and vice versa. Credit risk. The risk that a borrower will default on their financial obligations. This is particularly relevant to bonds or loans, where there is a chance that the issuer will not make the promised payments of interest or principal. Inflation risk. The risk that inflation will erode the purchasing power of returns. For instance, if the return on an investment is 5%, but inflation is 3%, the real return is only 2%. High inflation can diminish the real value of future cash flows. Liquidity risk. The risk that an investor will not be able to sell their investment quickly without a significant price concession. Less liquid assets, such as real estate or certain small-cap stocks, may take longer to sell, especially during market downturns. 2. What is return? Return represents the gain or loss made on an investment over a specific period. It can be calculated in different ways, but generally, it measures the percentage change in value of an asset relative to its purchase price. Absolute return. The total amount of money gained or lost from an investment, irrespective of the initial amount invested. This is a straightforward measure of how much profit or loss was realized. Relative return. The return expressed as a percentage of the initial investment. For example, if an investor made a 10% return on a $1,000 investment, they would have gained $100. Expected return. The average return that an investor anticipates from an investment based on past performance or statistical models. Expected return is often used in risk management to gauge whether the potential reward of an investment justifies the risk. 3. The relationship between risk and return. Higher risk equals higher potential return. In general, the more risk an investor takes on, the higher the potential reward. This relationship is a fundamental principle in finance. For example, stocks are generally considered riskier than bonds because stock prices can be volatile and influenced by various factors such as company performance and market sentiment. However, over the long term, stocks have the potential to provide higher returns than bonds. Bonds are usually seen as safer investments because they involve lending money to a company or government that promises to repay the principal with interest. The risk is lower because bondholders have a higher claim on assets than shareholders in case of bankruptcy, but returns are typically lower. Risk and diversification. Risk can be reduced through diversification, meaning spreading investments across various asset classes, e.g. stocks, bonds, real estate, and sectors, e.g. technology, healthcare, energy. Diversification helps mitigate the impact of poor performance in any single investment, reducing overall risk while maintaining the potential for good returns. Risk-return trade-off. Each investor must balance their desire for high returns with their tolerance for risk. For example, young investors with long-time horizons may be willing to accept higher risk in exchange for the potential of larger gains, while older investors nearing retirement may prioritize capital preservation and choose lower-risk investments with steadier but smaller returns. 4. Metrics for measuring risk and return. Standard deviation. A commonly used measure of risk, standard deviation quantifies the volatility of investment returns. Investments with higher standard deviations are considered riskier because their returns tend to fluctuate more widely around the mean. Beta. Beta measures the volatility of a security or portfolio relative to the overall market. A beta higher than 1 indicates that the investment is more volatile than the market, while a beta lower than 1 indicates it is less volatile. For example, if a stock has a beta of 1.5, it is expected to move 1.5 times more than the market. Sharpe ratio. This metric helps investors assess the amount of return they receive per unit of risk. The Sharpe ratio is calculated by subtracting the risk-free rate, such as Treasury bond yields, from the expected return of the investment and dividing the result by the standard deviation of the investment's excess return. A higher Sharpe ratio indicates a better risk-adjusted return. 5. The investor's risk profile. Risk tolerance. This refers to the level of risk an investor is comfortable taking. It depends on various factors such as the investor's financial situation, investment goals, and psychological comfort with volatility. Conservative investors tend to prefer stable, low-risk investments, while aggressive investors are more willing to take on risk in exchange for potentially higher returns. Investment horizon. The time frame over which an investor expects to hold an investment plays a critical role in determining their risk tolerance. Investors with a longer time horizon can usually tolerate more risk because they have more time to recover from short-term market downturns. For instance, a young investor with a retirement goal 30 years away can afford to invest in riskier assets like stocks. In contrast, an investor nearing retirement may prefer safer investments to preserve capital. Investor goals. An investor's specific financial objectives also influence the type of investments they should consider. If an investor is saving for a down payment on a house in the next few years, they may prefer lower risk investments to ensure their capital is protected. However, if the goal is long-term wealth accumulation, higher risk investments might be more appropriate. 6. Risk versus return in practice. Stock market. Stocks offer higher potential returns but come with greater risk, as stock prices can be volatile and influenced by a wide range of factors, including economic conditions, company performance, and market sentiment. Stocks tend to outperform other asset classes over the long term, but their short-term fluctuations can be significant. Bonds. Bonds are often considered safer than stocks, particularly government bonds, which are backed by the credit of the issuing country. Corporate bonds may carry higher yields, but also come with greater risk if the company's financial health deteriorates. Bonds provide regular income through interest payments, making them attractive to income-seeking investors, but their returns are usually lower than those of stocks. Alternative investments. This category includes assets such as commodities, gold, oil, real estate, and cryptocurrencies. These investments can offer extremely high return potential, but are often accompanied by significant risk, including the possibility of losing the entire invested capital. Cryptocurrencies, for example, are highly speculative and subject to extreme price volatility. Final thoughts. Balancing risk and return is essential to achieving long-term investment success. Every investment carries some degree of risk, but by understanding the relationship between risk and return, investors can make more informed decisions that align with their financial goals and risk tolerance. Proper risk management, including diversification and asset allocation, helps reduce exposure to unnecessary risk while allowing investors to capitalize on potential opportunities. Investors should regularly assess their portfolios and ask themselves, is the potential return worth the risk I'm taking? This self-assessment, combined with ongoing adjustments to the investment strategy, helps maintain the right balance as market conditions and personal circumstances change. A thoughtful approach to risk and return is critical to long-term financial growth and stability. Understanding the delicate trade-off between risk and return allows investors to structure their portfolios in a way that maximizes potential returns while managing risk appropriately.